So now we're going to open up this discussion. Thank you to those of you who's been chatting in some questions, and I'm excited to dive into it. And we're also going to bring back to the stage our pinch hitter, which is a term we started here in the US. So for 37 years, Nigel Pollard has worked in the pharmaceutical and natural medicines industry with a background in biochemistry, marketing, and international company directorship. He founded and ran a private enterprise that grew to 500 staff across 55 countries over 18 years, raising more than 100 million over that period. And after retiring from that company, he now chairs 3 international businesses and is on the board or advisory board for many others as he helps ambitious leaders reach their goals. So, Nigel, Andrew, Chris, let's dive in here. I wanted to start with a question. What's the most common mistake that CEOs make when it comes to funding growth? Are they thinking too big or too small? Is it the right place and the right time? Are they not doing their homework? Chris, what's your thought?
If I had the secret sauce recipe, that would be great. There's lots of mistakes you can make. It takes longer, usually, than what you think it will take to raise any capital, especially in the current climate. So start early and start raising capital when you don't need it.
Absolutely.
That would be the my advice and my key thing.
Okay. Nigel?
Couldn't agree more. I can only really speak to my mistakes, but the mistake I made, I think, in raising capital was just not allocating enough time for it. So when you're running a business, you're doing all the work that is needed for the business to operate, to support the team. You're often the pioneer of the idea. You're out there evangelizing. Raising capital is a big task. So I didn't allocate enough time. I think at least 60% of your time, so 3 days a week, you need to be investing for a year to realistically have a chance of raising capital. So that would be my personal learning. Invest time.
Okay. Invest time. Andrew, how about you? The big mistake.
Yeah, I'll add a little mistake alongside of those 2 good big ones. And that is the way of thinking about the capital. Again, as Nigel says, when you're in the business and you're close to the business, you are completely beset with what I could use extra capital for, how long it will take me, what it will buy me, how I will deploy it. When you put yourself in the investor's shoes, you've got a very important extra thing you've got to think about, which is exactly what am I going to do with your money? And how is it going to materially change the value of my company before I've spent it all? And so in fundraising terminology, that's called use of funds. So you're about to raise, you're out the market raising 5 million. You must know very crisply what you're going to do with that 5 million and demonstrably why your company will go from A up to B in value, having used that 5 million. A lot of people just think in longer term cash flow and business expenditure, but you've got to change that mindset and think exactly how am I going to use this little bit of money.
Okay. I'd like to follow up with a question that came in on the chat talking about what is the best source of small funds. So like maybe you need $1 million because you've got some cash flow and you're not looking for 5 or 10. I'd also add to that, why would you ask for $1 million instead of 5 when you might be able to think longer term, to your point, Andrew? And instead of saying, this is the exact amount I need down to the pencils, instead of this is my longer tail, I'm going to be a little bit ambitious. Chris, you leaned in there.
Yeah, on paper, it's easy to say, oh, why don't I ask 10 million and rather than 5 or 1? I'm sure can find ways of spending those 10 millions. But people will look at what Andrew was saying, okay, how are you going to turn those 10 million into 100 million in 3 to 5 years' time if you're VC, that's what your horizon is. So can you justify that gain in valuation over those 3 years' time? And also, it all depends, if your business is worth 2 million, it's going to be very difficult to raise 10 million or 50 million. Okay. So these are the limitations. So you have to also be realistic. And my advice, if you raise 1 million, look also at, I think what Mark mentioned, which is a debt funding. In Australia, there's a specific R&D tax incentive debt funding that you can look into. I'm sure there are things in the US that are corresponding. So you can find like small funds, but otherwise you've got angel investors or small VC. There are small VC firms that will invest $1 million US.
So now we've heard about multiple aspects to gain investment and the level of due diligence and work that CEOs are putting into finding those right type of investors. Are there different failure rates depending on the type of investor? You put in all this due diligence on private equity, for example. Does that make you less likely to fail if you're not putting in the same amount, if there's not someone asking the same questions for PE? That was someone's question, whether you have any insights on that. Andrew nodded a little bit. Andrew,
Yeah.
any thoughts?
Sure, I do. The success rate, and it was Chris's words earlier, in looking for smaller amounts of money, generally your success rates are higher because it's an easier ask. It is also a less rigorous marketplace. So as Chris mentioned, an IM or investment memorandum for a $1 million raise could be a 15-pager or something short. The investment case for a 10 million needs a lot more effort and a lot more time. As for absolute success rates in the angel community, you often succeed because all you've got to do is find the 1 or 2 individuals that really get you. Whereas in the VC and PE community, your business case has to be really strong. And if it's not strong, you just won't succeed. You've got zero chance of succeeding. So it's a harder answer about success rate. It depends on your business a lot in the big end of town.
Okay.
I'd also have to just chip in to add to that a little bit around the angel investor community and sometimes the family offices as well. I think finding the people who believe in what you believe in is really important. So if you're trying to raise these smaller amounts of money, then it's really critical to have an active plan to connect with people who are on the same kind of journey as you. It might be an adjacent investment to something they already have in the family office. So there's synergies there that are really attractive to them. So those smaller amounts, you might find, although the success rate may not be that high, you just need to find the right person.
Yeah. A follow-up there, Chris. Do you have any thoughts on finding investors of a particular type who have a passion for your business, your type of business?
Okay, so this is a very good question. This is a problem that I'm currently facing. I come from a more pharma background, so I know where to find biotech and pharma investors. My company is moving, it's this frontier between pharma and natural health. And so I'm not cognizant of the natural health ecosystem, investment ecosystem. So I have to dig in, and I'm just starting to build my list up. And so I have to connect with like the people on this panel and ask them where I'm gonna go to Expo West to talk to people and find people in that ecosystem that can point me to other people. And it's kind of chain reaction. Plus, as I was saying, the PitchBook, or PitchBook, you pay a lot of money, but there's a Shizune, some other investor database which are more affordable. And you can look at who has been investing in companies that that are in the same field. And then, do we have money? Do we have what's called dry powder, which is money in the bank that they're prepared to invest? So you can do some research like this, but you need to talk to people. That's
that 60% of time that Nigel was talking about, investing that time.
It's going to be even more than that for me.
Now, I'd like to take that and make that a little bit personal as well. You're talking to different folks, you're looking for the right fit. How do you strike the right balance between optimism and realism when you're working on your projections for your business? What is the future look like? How upbeat and positive, how American can you be there? How pragmatic and realistic do you have to be? Nigel, do you have some thoughts there?
Well, that was a question I asked, so maybe I shouldn't be the right person to answer
Okay.
it. But just maybe a couple of thoughts. I think the thing here is I believe in evidence. It's not just the scientific evidence for the products, but also evidence to support your strategy. So I think if you've gone and done some experiments in the marketplace where you've invested some money and you've proven a return on that money, and you can then show that you can scale the business, that's somewhere in between the two things of realism and optimism, because you can say, look, I've got facts that I can use to support this little pilot that I've done. I can then extrapolate. So somewhere in there, you need something independent that you can believe in yourself as well as sell to somebody else.
Right. Andrew, you mentioned specifically the need for evidence. Take me down your thinking there on pragmatic.
Yeah, it's a good question, and it is often confused, especially your own citing with your own accent of the American approach. New Zealanders and Australians are atrocious at understanding that, and they hide their light under the bushel, or whatever the phrase is, all the time. However, the core of your argument needs to be fact-based. So the idea of what language and what superlatives and what hype you put on it is secondary. The first and foremost thing is assemble your evidence. What is it, for everything that Chris and Mark and now Nigel have said, if I'm going to say that this is what my product can do, why am I saying it? I've got to stand behind it. If I'm going to say that this is the market it will enter, why do I think that? What's its competitive edge? Evidence, evidence, evidence. Once you've assembled that, then you actually wrap the hype around it, or should I say you wrap the language around it. And it is true that in US markets, and I've done a lot of business over there, you just need to use superlatives differently. You need to use self-promotion and ego differently than you do in our local communities. And you need to be able to be bilingual or trilingual. You need to be able to go over there and speak American hype to American audiences, and then come home and speak Australian hype to Australian audiences. It's not impossible to do. But whatever you do, don't mistake hype for content. Don't say, oh, well, I'm over there, so now I'll tell some really tall stories. That goes down just as badly in an American audience as it does in an Australian audience.
Right, right. Now, one question that I posed in our early discussions with Nigel, because of my work with women in nutraceuticals, and we have this focus on empowering female entrepreneurs, increasing funding, I'd be curious from your perspectives, do you see a difference in female CEOs, their preparation, how they're asking in terms of risk assessment potentially? What should female CEOs know? Is it any different than what the advice would be that you give to a male CEO in terms of finding funding?
Perhaps I'll chip in first, if I may. I think in this sector, my personal view is that it's a strength, to be a female CEO, because you're able to speak more for the target audience for many of these natural health products. And also, a lot of people who work in our industry are female as well. So I think there's, in terms of tips, I think there's an opportunity to emphasize being a female business leader as a strength in this particular sector, and why that matters in terms of understanding the customer and the staff as well. I know in Australia there are some specific funds around to support female entrepreneurs as well. So there are opportunities, I think, now that didn't exist in the past, which is citing for female entrepreneurs.
Thanks.
I will add that at the risk of being the wrong person to speak, because I know several of your attendees here are brilliant female CEOs. I would say that in the corporate world, the natural products or consumer health market is majority female, and that's talking right up to senior management. So including CEOs of some of those giant corporate companies. So it is not a minority situation like it is in many of the other sectors of our economy. But then I will add straight away, and you know this, and your audience probably knows this already, the subliminal biases that females face when pitching are profound and very hard to avoid. And they are around negative questioning versus positive questioning. Females will be approached, there's good evidence on this, by the way, approached to defend why the thing is not right, whereas males will be asked to support the reason why it is right. And that language is something that many women have to have grown up with and have to get used to. but it is still prevalent. So it's just a harder road, even though what I said about the majority is true, it is a harder road.
Thanks. Chris, any thoughts?
Yeah, more about if I think about the female CEOs that I know and how they approach capital raising, they tend to be very prepared, much more prepared than guys. And also what I've really appreciate and I mean that's what I see is that there's much less ego and much less ego projection from females than male when they interact, even in partnering events and things like this. So it's not like this is who I am. Have
Right.
you noticed me yet? The rooster syndrome.
That's right.
And I think in general, female CEO are much softer, stronger, but less posturing approach,
Great.
which I think is a big plus.
A couple of questions that have come in from our audience, our participants. In evaluating a company's worth, how much value is given to existing capital investment in manufacturing and supply chain? And is the outsourcing of raw materials or manufacturing seen as high risk?
It is true that there is a bit of a line between the future revenues and the bricks and mortar or the plant and equipment. And it is true that if you're talking to any of the venture investors or any of the risk investors, they will downgrade the value of your bricks and mortar or your plant and equipment. The reason being because they just see that as not what they're in for. They see that as something they can buy and sell down the street if they want to. This is not why I'm here on this conversation. I'm here because you've got potential to grow. In that same sense, outsourcing your manufacturing is not seen as a negative. Yes, it's a risk, and that risk must be overtly managed. But it generally, in the venture world or even in the corporate world, especially in the corporate world, who does the manufacturing is seen as a hygiene factor that you've got to get right, but it's not critically part of your value proposition. You've just got to have it really well buttoned down, and someone could do it for you. That's in my experience.
I think I'll just also chip in to the questions from John in unearthed medicinal mushrooms. And I think this is a very interesting question in relation to securing the product, actually, being clear what it is that this business is built upon. So although you might not be able to get that valued as such as part of the investor's view of the future of the business, it's a critical building block that's taken care of. And as Andrew said, that that's kind of sewn up and it's risk managed. Pretty much every company that I'm aware of in the natural health space is not controlling the whole supply chain. It's just not possible. So the way that the whole source to benefit process of the product is controlled is critical to the reproducibility of the product and the basis of the business. So I think getting that right is really important before you go to any possible investor, because otherwise you're on flimsy ground talking about what you can do in the future.
Okay, great. Now we had a question come in asking about any guidance of a level of investment split from both parties when looking at partnerships for market entry. So how do you structure it so we keep control of our brand from a startup perspective, but have that big company doing distribution, something that I think, Nigel, you also asked, are multinationals distributing other companies' products under their brand? Andrew, thoughts there?
Yeah, yes, I'll take that one. The pure distribution agreement is rare. And so I mentioned that on the way through, but it is true that they won't seek usually to just distribute someone else's brand. Remember that the global corporates are all about brand. They are there for their brand. They are there to build their brand. That's the legacy of 100 years sometimes. And it's on the stock market at value, sometimes at half or more of the total value of the company is the brand value. So the question of can we get them to distribute my product under my brand is almost asking the wrong audience. That won't work. However, taking your product and putting their brand on and acknowledging your product and highlighting your product as a vast improvement on their current range, that's all possible. That's all possible.
Okay.
So there are myriad examples, and of course I can't think of one quickly here, but there are examples. I remember Procter & Gamble buying a New Zealand company that was in the natural products world and happily taking that brand internationally because it filled a niche they didn't have, but it became the Procter & Gamble brand. It became the Procter & Gamble Snowberry. That's what it was. Snowberry brand. And that was wonderful. And the local founders were delighted. There was a little P&G stamp on the top left-hand corner, but otherwise it was called Procter & Gamble. Of course, it had to fit into the look and feel of every other P&G product. So it had a white box and it had a certain size and font and all that sort of stuff. But there was sort of a sharing of that. But the major opportunity to deal with the big guys is to actually think in their terms about what their brand is and how your product could add value into their brand, rather than trying to force your brand in.
Of course. Thank you, Andrew. We're wrapping up. Chris, do you have any, like maybe a final takeaway for our audience on this topic today?
I guess it's a critical function in being a CEO, capital raising and finding capital for growth. And you cannot grow, it's very rare that you can grow only based on revenue if you want to expand rapidly and if you want to expand in new market. So you will need some capital, whether it's from debt, whether it's VC, whatever. And this is going to take, as we all mentioned, as Nigel mentioned, a big chunk of your time. And so you need to be prepared for that. And it can't be a side activity.
Right. Andrew, final thought? Any quick takeaway?
Yeah, I think I'd probably sum up a lot of what I said by saying the corporate partnership world is not for everybody. I wish I had a nice crisp tick list that Mark Richardson had, but there are some things which you should say, if I'm happy with my business, if I'm entering my market, if I'm getting a reasonable return, please keep doing it. On the other hand, if you have aspirations for your wonderful invention to suddenly penetrate international markets, please consider global corporates.
Great. And Nigel, as we wrap up?
Thank you, Heather. I just wanted to say, I think it's a great opportunity to be a better leader and for your business to be better. And just working on this, talking to third parties, working on your business rather than in it. That's also a critical part of being a good CEO, and painting a compelling vision of the future is a big job for anybody who's running a business. So, and doing this with third parties is always good for you. So even if you don't succeed in raising the capital, you will be a better leader through the journey.
Wonderful. Well, thank you, Andrew, Chris, Nigel, and certainly Mark as well, and all of our participants today for what I think are some great insights that are really going to accelerate business growth for CEOs and those who are on their way to the C-suite. So just a reminder that these recordings and presentation will be available in that EBE membership portal. So make sure you subscribe to get even more guidance on how you build your business on evidence-based natural health products. So thank you for joining us. Best wishes for a great day ahead, wherever in the world you may be.